globally in the financial world in 2008. And really the central bankers made a choice. Do we want to have another environment where we have 25% unemployment and social unrest and serious problems, or can we have it so there's only 10% unemployment but have a longer slow period? And of course it's a better decision to have a longer slow period than a shorter V. And that's what the decision was made. And the tools the central banks used to, or the US central bank used to facilitate this long, slow recession rather than a deep V, was that term quantitative easing, which simply means they bought all kinds of securities in the marketplace and tried to put as much cash into the marketplace as possible. And the second thing they did is they made artificially low interest rates, like zero, for years and years. And of course, the Europeans copied Americans later. It took a couple of years. They don't like copying the Americans. So they still have quantitative easing. They haven't stopped that. The US is really where this success of this action paid off the best. Canada never really needed to do that because we frankly didn't have the excesses that the US had, so we never had quantitative easing. And 2018 is a really significant year, 10 years later, and this is the year that basically the punch bowl has been taken away from the party. There's no more cash. There's quantitative easing has become quantitative tightening. So instead of buying assets and flooding the market with cash, the Federal Reserve is actually selling their bonds and taking in cash. So it's the opposite. They've raised their zero interest rates to 2.5%. So economic growth did happen in the US, did happen globally, and the Federal Reserve's trying to do their job of stabilizing the economic cycle. So in 2018, they tried to get back to normal, increase interest rates so when there is a recession, they actually have room to move them back down again, and to try to get off their balance sheet all these assets they bought in the bad times. So 2018 was a very, the party's not happy. When the bar closes, people don't like it. And that's basically what happened in 2018. The bar is closed. No more punch bowl. But that doesn't mean the party's over. The party can continue after the bar's closed. But it's not as predictable. It's more volatile. And there is an end in sight. We will go home eventually. So people are nervous. And that's what's been played out in the marketplace. So what we have for you today is our structure that we've done every year at this time. But before I get there, I got to remember to tell you that we've hired a lot of young people this past year, a lot of portfolio managers that will bring clients and work with our clients. So I want to introduce the veterans here at Genus and our new people. So I'll start with Margaret Lantier here, Mary Lou Miles in the back, Sue Talbot, who's here, Grant Conroy, who stepped up last year when I had laryngitis. Stephanie Sue is here today after 1 year, like yesterday she started work after having a baby a year ago. So welcome back, Stephanie. And then we have Thomas Irwin from Royal Bank at the back there. And three people from HSBC that have joined us. Ian Lesher, who joined us a year and a half ago, and about 6 months ago, both Martin and Jill Besser from Nanaimo. Martin mainly works in Victoria, and Jill works in Nanaimo. And any of you are really interested in the election over there, I encourage you to talk to Jill after. She can give you the skinny. So welcome, everybody. That's the introduction. Quickly, what you're going to hear this morning, I'm going to give a couple of classic slides on the economy to justify, show you some evidence on why we're in the late cycle and why the party's not over. But more interesting, Wayne will get into what economic slides or issues we have found through our research give us good insight into what will happen next. So I'm going to give more classic ones. Wayne's going to give the ones that we've discovered are more meaningful in terms of predictive power. Then we will have Ian McEwen from Addenda Capital Management, who you've probably all seen before. He helps us pick the bonds. We hired Addenda in 2008 to manage our bonds. We've been very happy, mainly because of Ian. He's terrific. and he'll give you a little deeper drill down on what bonds we own and why and how the bond portfolios have done, including the mortgage portfolio. Wayne will come back after that and talk more about security selection, what stocks we own and why. So I'm talking at the very high level. Wayne's going to get more into asset mix. Then we'll drill down into what bonds, what stocks, and then I'll come back at the end just to tell you how you've done and how you're positioned. So with that, so this is our famous train that we've shown at this seminar for years, and the US has shown the leadership all through this cycle with the quantitative easing, with the zero interest rates, and it's bitten down there better than anywhere else in the world. The US economy has been the leader from a GDP perspective the last couple of years. 2018, 2019, GDP is slowing around the world. Global growth is slowing. It's still positive, but it's slowing. But the US is still leading. Still the best growth in the world is the US, even though US growth is lower now than it was a year ago. So the main thing that the US has done so well compared to the rest of the world is tackle unemployment. So this is a chart that simply shows the Eurozone, Canada, and the US. It shows how they've done such a great job of taking their unemployment from 10% to full employment. Really, it says 4% unemployment. Those people, it's very difficult to get below 4%. So it's working really well. Canada never had the high or the low. And the Eurozone, of course, has been in bigger trouble. Spain and so on, all the noise we've heard over there. It is better there now, but it's still not clicking the way a normal economy would be clicking. The US is showing signs of a late stage cycle. So again, this is the blue line is the unemployment line that we just looked at. Tremendous profile. And there you see the Federal Reserve interest rates down, locked at 0 for years and normalized very recently up to 2.5%. So this is kind of the big picture evidence of why we're in the late cycle. However, what often drives the economic cycle after the punch bowl is taken away is the effects of the punch bowl, which is earnings and earnings growth. And that usually does continue at this stage of the cycle. It is continuing. We have very good earnings growth in corporate America, and that's a good thing. U.S. confidence, that's important because, of course, the U.S. consumer is 70% of the U.S. GDP, so it's very important. People are employed, they're spending their money, they're happy. They're not really happy, as we know, because they don't have, because of this wage gap, this wealth gap that's happened, and the fact that, well, they may be employed, may even have 2 or 3 jobs, earnings growth in their salaries is so muted. So there still is a very large percent of the population that is not thriving, but consumer confidence is good, people are spending their money. I just have to throw out this thing I read in the Globe yesterday that I didn't read the article, I just read the headline. But there was a poll that 50% of Canadian families are $200 away from insolvency. So they are, just because of low interest rates for so long, people have borrowed so much, but they're still spending. They're still happy and they're still spending, but it is something to make us nervous when the cycle does end. Manufacturing, purchasing, this is very interesting. Purchasing Manufacturing Index. This is actually a survey sent to corporations by the U.S. Economic State Department. And I don't know what actually department, but somebody sends this survey out to all these corporations. So it's very interesting. It's the mood of corporate America. And are they going to be purchasing more or not? Are they growing their inventory or shrinking their inventory? So you can see, and the reason the 50 is highlighted is because it's 50, it's above 50, it's good, it's below 50, it's bad. So you can see China is the bigger worry than the US by far, and its growth is slowing faster than the US. But it's still positive. House price index, I would love to get a better pricing index for Vancouver. It's really hard to get. But of course, we all know it's slowed more dramatically than the Canadian index. Places like Ottawa, small towns in Canada are thriving. Vancouver is probably the weakest real estate market in Canada. So that line doesn't really reflect what's going on here. But there's definitely a pause happening in Canada. But these lines are on the way up, and that's good. We always end with this slide. This is my, you cannot come to a Genus seminar without seeing this slide. This slide is the price of oil and the Canadian dollar. And when we started Genus in 1989, we knew this relationship. I see a relationship. I don't know if you do. But in 1989, we said to ourselves, Canadians are so exposed to the price of oil, they don't realize it, because their assets are in Canadian dollars, and that Canadian dollar, by definition, is exposed to oil. So, and the Canadian stock market is 15% oil. So if we're going to advise wealthy Canadians on how to invest, we need to get your money out of Canada more than the average manager. So you'll see when we look, you know this is what drives us, one of our policy instruments that we use in creating your portfolio. So this is a great segue into, I think it's a great segue into Wayne's speak on big picture asset mix. I didn't introduce Wayne. Wayne is the co-founder of Genus, our CEO, our chief investment officer, and so qualified to speak today.
Our process, we call it our dynamics process for asset allocation. If I can get this working here. We start off by looking at signals or information from the markets in 6 different categories. We look at the economy, what's happening to the economy. Usually if the economy is good, it's good for stocks. We look at valuations, is the market expensive or cheap? We look at monetary policy. Is the money supply growing? Interest rates, what's happening there? Interest rates are very dominant in terms of driving markets. If you look at interest rates, for example, treasury bills, if treasury bills are falling in a given month, there's a 60% chance that the next month the market's going to be up. And so vice versa, if rates are going up, there's a higher chance of markets going down. So these things actually do matter over time. And we also look at risk in terms of credit spreads. Are credit spreads expanding? Are people becoming more risk averse? And we look at inflation. If inflation's going up, it's usually not good for the economy because it means the Fed's going to have to raise rates longer term and take away the proverbial punch bowl. And also we look at technical indicators which can help preserve value in down markets. So we have these 6 different categories of indicators. We look at indicators that are non-correlated with each other and put them all together and effectively into a voting booth. And I'll give you more example of that later on in terms of how that works. Just to show you some of the value added we've got from the system over the past. From 2013, we've been using the system. I don't know what the heck we were doing over here, but from here forward, we've added value, about 40, 50 basis points in terms of value added. And the issue here to me is not so much the magnitude, but the consistency. It's adding some value. If we can add more value with stock selection, that's a good thing too. So it's been helping us make decisions and maybe sleep nights over the past 4 or 5 years. Now, so what's the system saying? What's our system saying right now? Looking at the 6 different categories, the overall score is 2.5, 2 out of 5, for example, which is cautious. This turned cautious in early 2018, and since then we've been reducing equities and becoming more defensive within our equities. So what's causing the caution? Number 1 is the economy. One of the indicators we look at, Leslie mentioned, this Purchasing Manager Index. You saw how it's rolled over internationally. So the caution really is coming from the global economy, not so much the US, but China and Europe. They're still struggling to get going here. Valuation right now is neutral. It was more negative up until recently. Earnings have improved as have prices have come off. That's helped. Risk and looking at corporate spreads is still okay. Nobody's freaking out in the bond market, in the credit markets. Right, Ian? You're not freaking out? Okay, okay. And monetary policy has definitely been on the tight side, okay? And I think the market's been screaming at the Fed that you're too tight, buddy. So that's been an impact. And technicals right now are neutral. So overall, 2.5, 2 out of 5 for a score on the cautious side. Let me go through some of the individual indicators now and sort of just walk through some of the ones that we look at. This indicator in oil, the movement in oil this is a year-over-year change in oil. You can see it was up 50%, and that triggered a negative score in terms of inflation. But since October, it's collapsed. We think this indicator is still showing a bit of negativity, but it's going to become more positive as time goes through the piece here, and the impact on inflation will be definitely a positive one. So this could swing this indicator more to a positive side in a couple of months, we believe. And if you look at inflation, we don't think it's a concern right now. If you look at the year-over-year change in U.S. labor costs, they tend to lead U.S. inflation. So this is blue is CPI, the green is the U.S. labor cost. There's a lead there of about 6-7 months, and you can see it's saying that inflation is going to roll over. And you would expect that given what's happened to markets, given what's going on globally with technology, everything else. So we don't think inflation is a problem, and that's what the bond market's been saying to the Fed. So these indicators are a bit negative right now. We think they're going to become more positive over the next 3 or 4 months. If you look at risk, this is the corporate spreads and also high yield spreads off treasuries. You can see how they got blown out in 2016 and 2011 and really got blown out in 2028. We're nowhere near that right now. They've widened a bit, but they're still okay. People aren't freaking out there. If you look at monetary policy, excuse me, you can see that China, being the red line, is coming down, and their money supply is approaching about 1%. It's really the lowest level in almost 20 years. And you look at the EU. The EU is up around, EU is around 6-7%, and US is around 5%. So not stellar growth. And that's what happens exactly. The markets and the economy are competing for liquidity, and when the economy gets going, it takes more liquidity and puts the squeeze in the markets. And we've seen that. And so it's not great liquidity, but still it's not negative. You can see what, for example, in the US in January 2007, liquidity, money supply went negative. That's usually not a very good sign when you have negative growth in money supply. It won't sustain the market going forward. And if you look at the Fed, excuse all the dots here, but I'll try and explain this mess. The dots here represent, going through 2019, 2020, 2021, are the votes from the Federal Reserve, the so-called 12 wise men. And the line represents, the dark line here represents their average expectations of interest rates. The light green line represents the expectations of the market. So the market expectations are below the Fed. And that's why I think the market got upset when Powell came out and had a conversation about their monetary policy. He was just frankly a little too nonchalant. Him and his 12 buddies get together and they just take a straw poll, and that's the way it goes. And also they're going to put the quantitative tightening on autopilot. So I think the market didn't like that. They wanted somebody who was a little more sensitive to what was going on in the world, especially with the global side, with the international side being so weak. So that's why I think what dragged the market down the second half of that correction. And the talk right now, the consensus right now is that the Fed is done. They're not going to raise rates this year. It's over. It's done. And so the market seems to always get it right. And this is the 800-pound gorilla in the room. As Leslie mentioned, we've had quantitative easing for 10 years. You can see that China grew their balance, China's central bank grew their balance sheet to over 5 trillion, as did the EU, and Japan's there now. US got close, and now they're contracting. The interesting point here is they're all coming down now. Here's coming down, coming down, coming down. They're all coming down. So you've got $25 trillion of bonds purchased by central banks around the world, and it's done. It's done. We've bought all the bonds we can buy in the world, and this has to be unwound. And I think what was going on, I think the Federal Reserve thought they could do it faster than they actually could. And I think it's going to take a long time to unwind this. You know, obviously, 2008 was a really severe recession. There's been a lot of debt built up since then, and the economy is just too sensitive to higher rates. And I think that is the message here. And so it's going to be a go slow kind of environment in terms of the central banks tightening, and rates are going to probably remain a bit lower than we anticipated going forward. And I think you're starting to see that right now, actually, in the if you look at some of the housing sector stocks in the U.S., they're starting to outperform as they see rates come down here. So that could be a good sign, maybe longer term for home building and housing. I'm not sure about Vancouver, but maybe for the rest of North America. And if you look at the yield curve, this is the spread between 10-year rates and 2-year rates, I believe this one is. And it really, why it's important, because the 10-year rates are driven by market expectations. The 2-year rates are driven by the central bank. And whatever they get, the 10-year gets below the 2-year, it tells you the market is expecting lower inflation than the Fed, or lower growth than the Fed. And so, and typically it's been a pretty good predictor of recessions. You can see it went negative here in 88, 89, we had a recession, went negative in 99, big time had a recession, went negative in 07, had a recession. It hasn't gone negative yet. And typically when it goes negative, it takes 18 months to 2 years to have a recession. So we have some time here, we think, before the next recession. The economy so far has been driven by liquidity. As I showed you that $25 trillion of liquidity of paper printing money by the central banks. The next phase, typically, the last phase of the economy typically is driven by economic growth. And we really haven't seen that yet. We've seen a bit of it in the US. It hasn't happened in Canada, hasn't happened in Europe, hasn't happened really in China yet. So that is the hope that basically this pause here, central banks repositioning, providing more liquidity, inflation not a problem, can give us one more leg, a classic late cycle leg where the global growth gets synchronized. And typically in that environment, it's not a bad environment for Canada because people buy commodities and China gets going and everything else. That's the hope that over the next 2-3 years, we'll get a synchronized global growth, typical of a late cycle. We just won't fall into a recession this year, as some are saying. We don't believe that at all in terms of recession this year, but strange things can happen given trade wars and everything else. If you look at the recent correction in the market in the last quarter, it was a garden variety correction. It happened, for example, very similar to what happened in 11. Kind of reminds me of the one back in 1998, this guy in here. And so we don't think it's the end of the bull market, but we're into a phase right now, we think, where the market's coming to facing the reality that we're in the last stages of the cycle. It's been a long cycle, and it's not going to, I think the market's going to become more cautious in terms of pricing growth, and it's going to want to see the growth manifest. I think valuations are good right now. I'll get to a chart on that in a few seconds. But I think going forward, the market's going to want to see the proof in the pudding. It's going to want to see the growth of earnings to go higher. If you look at the markets since the end of 2017, the U.S. has outperformed by quite a bit here, by about 10-12%. And the TSE has lagged. Emerging markets, I'm surprised how correlated the international market is, emerging market and TSX. That's the international side. They're all correlated. They're all moving the same area. So if we can get this international side going in a late stage type phenomenon, these areas can all do well. And the U.S. has been driven more by domestic growth and tax cuts, and also the technology side of the equation. But U.S. has definitely outperformed. And it's also manifest in the earnings. If you look at the earnings of the U.S. Over the past seven years, they've outperformed the world ex-U.S. here quite dramatically by 50 points. That's probably around 35%. Excuse me. So, and why is this? Well, I think technology has been a big factor in terms of improving earnings. Globalization has been really good for U.S. corporations. Globalization has been a great winner for U.S. multinationals. Not so good for the middle class, but it's been good for U.S. corporations. And so that's one of the reasons why the U.S. outperformed. They simply have better earnings power than the rest. And these numbers here are the projections going into the next 2 years. This is up around 8-9%. These are top-down forecasts from analysts. They're usually too optimistic. You maybe want to cut that in half, but you're talking about 5 to 7% growth next year in earnings, 161 to 173, and then about 8-9%, I think, for the next year. So still projecting earnings growth over the next couple of years. And I think that's enough to drive the market forward. If you look at valuations, how we look at valuations, we look at earnings to price minus the treasury yield. So it's, instead of the PE, we invert the PE, earnings to price, minus the cost of the short-term borrowing cost. And that gives you an idea of it's not a bad value indicator. And so recently, you can see how Europe has gone into the cheap, but no one seems to care given all their issues with Brexit and everything else. And Canada is also looking pretty good. U.S. was becoming a bit more expensive, not in the expensive category, but a bit more expensive. But now it's actually become, I'd say, fairly valued at this point in time. And so overall, we're scoring this a 3. So I think this is important. I think that, and that's why I think earnings growth. I think the valuation. I don't think we're going to get the markets aren't going to get a lift in valuation. The next lift is going to be driven by earnings. So it's going to be, and that's typical of last stages of a cycle. Earnings have to drive the market higher. So we have to see the earnings, we have to see the economic growth to drive the market higher over the next couple of years. So that's a look at some of the indicators that we look at that go into our modeling, into our dynamics modeling. And so putting it all together in this scary, whatever it is, you can see you can see that when it's green, typically the models are positive. When they become a bit more red, like they've become here, you can see too bad we didn't have the time scale on here, unfortunately. But we'll have to get the graphics improved next time. We have the time scale, you can see that this here was probably 2007, 2008. A lot of red in there. And this was probably 2000, that space there, but a lot of red there. We're getting some red here, obviously. And so, and adding up the numbers, you can see the economy in the last month went from a -3 in terms of our vote counts. You can see that we have 4 indicators in the economy. Or 5, I guess we have, 5 indicators. And so we add them up. If they're positive, it's a +1. If it's negative, it's a -1. Right now, the economy's showing -4. And that's more of a measure of the global economy, not so much the U.S., but a measure of the global economy. If you look at valuations, -1, and risk is still a positive. We have the TED spread in there, the spread between the Swiss franc and the Aussie dollar carry trade. Inflation is a -2. Gold's been popping there, but we think we're going to get kicked. This is going to go positive here in the next month or 2. And so it's been a negative. And money supply has been negative as well, the whole monetary policy, China, U.S. But with China starting to throw weight into getting our economy turned around, this could go positive. And with some help here, we can go positive here as well. Technicals are 0. So overall, right now, I think we're we've gone from -6 to -8, 3-month moving average -7. So still pretty negative. And that's why we've been raising cash in the course of last year, why we've gone from more growthy stocks to defensive stocks. And just looking at the vote counts, this shows you what we're actually modeling here. We're modeling world equities versus cash. This is the performance of world equities versus cash. This is the signal. If it's red, it's a sell. If it's green, it's a buy. And it went red here you can see in early 2018. This shows you the vote count of our signals. They get as high as around 12 or 13 when they're bullish. In 2007, 2008, they went to about minus 14, minus 15 in 2001, and right now we're about minus 8 at this point in time. So still negative view on global markets. We've become more defensive. We're watching and waiting. And what we think we're starting to see some light at the end of the tunnel in terms of inflation, in terms of monetary easing, which will hopefully move these signals higher. And just this is sort of the complete asset allocation work we do, showing you we have asset allocation models, equity models, bond models, and commodities. And you're not seeing a lot of green here. There's a lot of blue. So blue is neutral, green is buy. So for example, green is a buy. So it means that US bonds have become a buy versus cash. This has happened like last month. So we started adding some bonds to our asset allocation, to our portfolios. World versus cash is still a red, as I showed you there. TSX versus cash neutral. S&P is neutral. Actually, the S&P has always been a buy over U.S. bonds up until a couple months ago. So it's gone neutral. So starting to favor. You're seeing bonds becoming more and more into the mix, and TSX is still a sell versus Canadian bonds. Looking at the world in terms of regional allocations, world to S&P is still likes the S&P over the world. Likes S&P over, it favors S&P over TSX. Neutral versus EFA. Valuation-wise there, we're still looking for a story. And EM to world is neutral. And still likes defensive stocks over cyclical stocks. On the bond side, it's still favoring the short side, favoring governments over high-yielding corporates. And commodities, currencies, neutral, still doesn't like oil, but neutral across the currencies. Dollars had a nice rally here. I think what we need really to get something going here is for a bit more Fed dovish talk or softness. Put a cap on the US dollar, let the other currencies rally and get the markets going here, which will also hopefully help the emerging markets as well. So that's our perspective on the asset allocation side. We can ask questions later on. Leslie, is that the idea? Or just yes. No, we don't. We don't have everything we look at is simply numeric, and I would just say that a lot of the political risk is born in credit spreads and those. That's where I think that these kind of things get built into the numbers. Okay, next up is Ian McKinnon. He's been our bond manager for like 10 years, and Ian was with Addenda. We partnered with Addenda about 10 years ago, something like that, and we partnered up with them. And as soon as we partnered up with them, they got bought. They got bought by cooperators, and you know what? It was the best thing that ever happened to us because we got Ian in the trade. He was like hidden gem, and we also got the mortgage managers out of Saskatchewan who've been really blessing for our firm and done well for our clients. So it's been good. But here's Ian. He's going to tell us about bonds.
Thanks, Wayne. Is this on? Thank you for that wonderful introduction, and it's been a pleasure for us to work with Genus as well. I'm going to go into the slightly more boring part of the presentation and talk about the fixed income world, but I'll go quickly. Please ask questions. I'll do a quick review. Wayne's covered, and Leslie, with all your economic charts, you've really covered off, I think, that the macro environment, the fundamentals very, very well. So you'll see, I'm just going to talk a bit about what happened in Q4 and last year, and then we'll go into our outlook for 2019. So the yield curve was a big story. As you know, we have this term structure of Canadian interest rates going from 0 out to 30-year bonds. And here I'm showing 3 different yield curves where we were at the end or beginning of last year. So 2017 is the green line. Where we were in September is the magenta line, and where we finished the year at the end of 2018 is the blue line. So there was an upward pressure on interest rates sort of throughout the first 3 quarters of the year. And I would say really volatility was back. So we saw different shocks. The equity markets got hit January, February when vol came back. Rates fell, then they rallied back. Then we came into some trade concerns with the NAFTA going away, some tariffs being put on Canada by Trump. Interest rates fell, but then once that was somewhat resolved with the USMCA, although it hasn't been signed yet, rates pushed up in September. And then we came into Q4, and it seemed like a real confluence of little things weighing on the markets in general. Central bank tightening, sort of slowing economic signals, especially overseas, trade war concerns, and then the equity market started to get volatile, and we saw rates fall dramatically in the fourth quarter. So effectively, at September, bond returns were negative if you look at the Canadian bond market, and then we had a fairly strong Q4 and made all that money back. Really, the other theme to mention, though, is curve flattening. So you've probably heard that term. That's where shorter rates are moving up more than longer rates. Wayne showed the slope of the yield curve in the US. Same thing in Canada. So we had a lot of pressure. The Bank of Canada tightened rates 3 times for 75 basis points last year, pushing up those sort of 1-2 year rates, while longer term rates actually fell a little bit. And again, that's due to that inflation outlook and or just generally somewhat slower growth, or not overly exuberant outlook for growth. So long rates were still able to stay lower. What happened in terms of actual returns? The universe is all the bonds in Canada, Government of Canada, provincial, municipal, corporate bonds, all terms and all rating categories. So it had a 176 return in the fourth quarter, but you can see how it was negative at September. So very, very good fourth quarter. Short, mid, and long. We define short as 0 to 5 year, midterm is 5 to 10, and long is 10 years plus. And again, when interest rates fall, longer term yields give you the best value. That's where prices go up in long bonds the most. So you saw long bonds really had a strong Q4. When you look at the sectors, Canada, provincial, corporate, as Wayne mentioned, credit spreads, which we have an embedded credit element in provincial bonds and in corporate bonds, you need that extra credit spread to compensate for the risk. They widened in that risk-off environment when stocks were selling off. So provincial and corporate bonds lagged. Government of Canada was the best place to be in the fourth quarter as those yields fell. In terms of returns, so we manage a whole suite of fixed income products for Genus, and they pick and choose what makes sense. And as Wayne mentioned, they'll allocate away from one and into another. I think we've been adding to the government bond, Wayne, you mentioned recently. So just looking at some of the returns, duration is a measure of interest rate sensitivity. So shorter duration is less sensitive to rates going down or up, and vice versa, longer duration is more sensitive. And certainly yield, I think that's pretty understandable. The higher, the better. For us, if you look at the returns last year, interestingly, so mortgages has been one of the best returning categories, and Wayne gave us kudos for that. Canadian commercial mortgages, I'll talk a little bit more about the portfolio specifically, but domestic, very stable yield, effectively, with low volatility. Very consistent, you can see over the 4 years, and the current yield at 3.5% is pretty attractive relative to where other rates are. The second best return, though, was the short rates. And again, this talked to the volatility in the bond market. As interest rates were rising, as the Bank of Canada is rising rates, you're actually seeing somewhat better returns in that short area for a change. Going from 0 way back when to actually getting a bit of a return in the money market these days. So that's kind of nice. The fossil fuel-free corporate and the strategic bond are more corporately focused, generally in that midterm area, 5 to 10 year, sort of a sweet spot for corporates. You get better yield there, but you are exposed to the credit markets doing their thing, and so Q4 was not as friendly for corporate bonds. And finally, the government bond being sort of the safe haven, certainly less risk, somewhat risk-free, but lower yield overall. So that's it for the review. I can pause for questions if there is any. Oh, it's at the end. Just wait for it, Leslie, wait for it. So I'll go into the outlook and I'll give you a little insight into our fearless forecast. I think it's going to dovetail very nicely with Wayne and Leslie and the group of their views as well, and talk a little bit about the portfolios. So in terms of our themes, our strategy and our themes, really we do see slowing global growth, and I think we're going to see slowing growth in North America as well. There are some signs of a recession, but we don't believe that is not our base case. As Wayne mentioned, we do not believe we're in a recessionary environment, but we do think we're going to see growth slow. U.S. growth last year is going to come in probably north of 3% on average for 2018. It'll probably slow more into that 2 to 2.5% range. Again, still positive. That being said, central banks have been raising rates. The Fed has tightened 9 times over the last 3.5 years. Bank of Canada has tightened 5 times. We're now well above zero. And I think there are they're going to have to be careful. They've been going very slow, but the economy is a little more sensitive to interest rates these days than I think it was if we go back 10 or 20 years ago, and I'll show a chart to that effect in terms of household debt. So I think this is also why, as Wayne mentioned, central banks are on pause right now. With the Q4 results, the volatility coming back into the equity markets, also in the credit markets. As much as Chair Powell said things are on autopilot, he came out early in January and somewhat softened that statement, saying that, you know, we'll reassess as we go forward. And our expectations are that probably both the Bank of Canada and the Fed are at least on hold for the next 3 to 6 months. Evaluate the data. If it's strong, they'll probably tighten a little bit more as expectations are as they forecasted. If it continues to weaken, they can go in the other direction, and they've said that. So what we do in terms of the bond portfolios, in the environment we're in now, with not a lot of inflation, with central banks perhaps on hold, with the economy growing but not super strong, we think that just means interest rates stay in a lower range. So we're not going to see as much upward pressure and not necessarily downward either. So for us, that's sort of a trading opportunity. As rates rise, we'll take some risk, we'll extend our term, and as rates fall, we'll pull in our horns and we'll get a little more defensive. Liquidity is important these days, just with the volatility we saw in Q4. You know, whenever that happens, investors really get defensive and liquidity tends to dry up. So for us, we're being very conscious within the portfolio, within the bonds we own, making sure we have adequate liquidity so we can trade, so we can take advantage of opportunities. And finally, there is the potential that if the economy did slow and the bank had I think the market would move to anticipate the banks would cut rates, yield curve may steepen, and so we'll position ourselves a little bit longer to take advantage of that. But we're not there just yet. We're not in the bank cutting forecast just yet. Credit is another area. So as we go into these sort of somewhat late cycle volatility times, credit spreads can be very, very jumpy. We're somewhat cautious. As Wayne mentioned, his indicators, we're following very similar indicators. And I actually really like when his indicators match up really nicely with mine. And it's giving us the same signals that you don't want to be really aggressive right now. So we've positioned defensively the portfolio. We still have exposure to corporate bonds, provincial bonds. We're getting that extra yield, but we're within the portfolio somewhat more defensive. So we're holding more utilities, more financials, more infrastructure, names that we think will be, I'll call them lower beta, if you will, less sensitive to market gyrations. When and if the market does suffer another healthy correction, that's a buying opportunity for us. When spreads widen, then we can add to that risk. And there are risks out there. I think, as you mentioned, the geopolitical risks that are going on. It's really hard to quantify those. I think they are somewhat embedded in the market prices. As Wayne says, the market is the market. It's the collective intellect and viewing all the fundamental indicators that are out there. But there's a couple of risks. The big one would be the trade war. If Trump really wants to go at China, I think that's negative for everybody. So that's something that we have to watch. It certainly would be negative for Canada, as well as just you know, general, whether it's Brexit and whether it's Italy and whether it's the Middle East, there always seems to be something, emerging markets suffering a little bit. Again, as an old bond guy though, volatility means opportunities. And so I don't mind that volatility. Hopefully I can position properly for it. And then as that vol, even if it's a negative event, that gives me an opportunity to add risk. So the one chart that I wanted to show, and as I was suggesting that the Canadian economy at least is more sensitive to interest rates, and this is household indebtedness. And as you can see, we're sort of pretty much at almost 50-year highs. A big chunk of it is mortgages. Now this chart on its own looks really scary. And so as the Bank of Canada is raising rates and the market is raising rates, this should have a slowing impact on the economy. Throw in top of that some regulatory changes that we made with Canadian Mortgage and Housing Corp, tighten up quality and application standards. The other side of this chart that you don't see, though, is the asset side, right? So this is only half the story. There are assets usually backing, at least in the mortgages, a secured debt. You've got a house price. House prices have gone up a fair bit since 1970, as I'm sure you're all aware. So when you look at it, and while there may be RSPs and stock portfolios and whatnot that are behind this, that are backing some of this debt. So I don't freak out when I see this chart, but what it tells me is that maybe the Bank of Canada doesn't have to raise rates as much as it would have back in the 70s or 80s to slow the economy. We're somewhat more sensitive to that now. So that's also a part of our premise, that we just don't think central banks are going to necessarily get back to where they want to get, that neutral monetary policy, which is maybe 3 to 3.5. We think they probably end up stopping short of that. And so rates stay a little bit lower. Again, probably better returns from the stock market than from bonds, but just lower yields. So what do we do? How do we try to manage around this in the bond portfolio? Couple of ways. As I say, we're trying to position it kind of safely. Financials, infrastructure. We look at impact investing a lot at Addenda. The investments that we have in your portfolio, how do they impact the economy? It's an ESG. It's the fossil fuel-free approach. Trying to look at long-term sustainable corporations. Coast Capital is the largest credit union in Canada by membership. It's based here in BC. It's a great little hidden gem, I think. It was the second credit union that just went federally regulated, so it's regulated by OSFI instead of provincial. You can look at this bond. They've come to the market twice. Being from cooperators, and it's a cooperative, I understand that these member-owned organizations may be better than other investors. 5.25% yield for a 5-year bond was a no-brainer for us, and it's a really quality credit union. They're looking to grow. Their credit metrics are really, really strong. I think it's an investment that wouldn't have been available to many of the folks in this room, but it was something that we could take advantage of for you. The Autoroute Trente, this is a big highway in the south shore of Quebec, in Montreal. Again, it's what we call these private-public partnerships, where it's funded by the private, but it's supported by the public, by the government. So the government of Quebec will eventually, it has a toll road portion. It's just a refurbishment of a highway. It's really boring. They issue debt to help pay for it. 3.75, it's got a nice yield on it, long-term, low vol, shouldn't react in a negative or a positive economy. They should just be making their payments. So that's good for us. And finally, the Wolf Wind project, that's just outside Kingston in Ontario. It's a big wind farm, positive impact on the economy, renewable energy, we like that. Also longer and a nice yield of 3.80 on it. So again, offering attractive yield, what I believe are low volatility type situations, should be able to weather even any economic slowdown. And finally, the hidden gem of Addenda Cooperators is our commercial mortgage team. They're based in Regina. I think they have 5 senior portfolio managers now. It's a Canadian domestic commercial mortgages. It's geographically diverse, and it's diversified by property type. It has a yield, I think I mentioned, about 3.5 to 3.60. Very short duration, so it's short sensitivity to interest rates. They generally write 5-year mortgages. They don't want, I think borrowers would like to write a 10-year mortgage in this low rate environment. They don't believe in that. They don't want to do that. But so what happens, about a quarter of the portfolio matures every year. So even if rates rise, they get to roll over those mortgages into newer and higher rates. So it doesn't demonstrate a lot of interest rate sensitivity. You just crank out, the yield they're getting on mortgages these days is about 1.75 to 2% over the Government of Canada 5-year. So as the Government of Canada 5-year goes up and down, their yields will change a little bit, but that spread is very, very stable. And it's just had consistent long-term returns. And low loan to value too. These guys, it's very conservative. Only first mortgages. They kick all the tires for all the properties they buy, and they do not take risks. There's no hotels in here, and there's no single-family residential mortgages. It's only commercial. So it's been a great source of, I'd say, a defensive yield, maybe within the Genus portfolio. So I'll pause there. That's the quick turn. So in multifamily residential, like apartment buildings. So we don't do any single family, like not you and me, but they will do apartment buildings, very stable. They'll look at the low vacancy rates, all that sort of stuff.
So next on the agenda is Wayne's coming back to drill down into the equity portfolio, talk more about the specific stocks that we own. You're being very good.
Before I get to the names, I'm just going to start by talking about our approach, how we approach the equities, and in particular, our core funds, our CANGLOBE fund, and our dividend strategy. We started taking it's called really a total equity approach, where you put all your equity into one portfolio, your Canadian, your U.S., your international one portfolio. just helps improve your diversification. You can focus on what region does the best. And for example, Canada, really in Canada, you want to buy our financials and our natural resources. We go to the US for technology, healthcare, consumer brands. International is more about the industrials and some healthcare. And right now, our benchmark, if you will, for these funds is 35% Canada and 65% global. And the whole idea here is get the best of best from around the world. So that's been our benchmark for probably the past 6-7 years. I would think that at the end of the next cycle, whenever that may be, maybe sooner, we'll start shifting Canada down from 35 to 25%. Just in terms of looking at wealth opportunities, Canada is so concentrated in terms of 5 banks, a couple insurance companies, and the oil sands effectively. And apart from that, there's not a lot else. Maybe some cannabis stocks, one retailer, a car auto manufacturer, and what else? And a cheese maker. So it's quite limited. And I just think in terms of getting more diversification and less exposure just to the energy sector, which is then connected to the banking sector, it makes sense to get more globally diversified and look at more wealth-creating opportunities. But anyways, that's for another day. Moving on to how we actually pick stocks. We cover the top 2,000 stocks around the world, and we have almost 50 models that we actually use to help us pick stocks. We have regional models, we have sector models, but each of those models are based on these 6 different characteristics or factors. We look at value. Is a company expensive or cheap? We look at growth. Is a company increasing its cash flow, its earnings? Look at expectations. What's the street saying about a stock? If they're raising their estimates or their targets, it's usually good for a stock. We look at price momentum. That's an important factor, especially in Canada, given the cyclicality of the market. We also look at quality. And we started introducing sustainability about 2 years ago. And the big idea there is that sustainability is really a quality factor. Are companies doing the right things, good things? If they're, doing things like, for example, Volkswagen did, it's going to impact their stock in a negative fashion. So it's really a quality factor, a risk factor, and it's becoming quite common now across a lot of fundamental teams. They'll have somebody who focuses on ESG or environmental social governance issues in terms of just assessing the risk of today's company, today's market. So we'll rank the stocks from A to F, and we buy the high-ranked stocks, sell low-ranked stocks, and we use risk models. This here is an example of our CANGLOBE active weights. What's an active weight? An active weight is simply the weight above benchmark weight. So our benchmark, as I mentioned, was Canada 35%, the TSX 35%, 65% MSCI World Index. So within that, for example, we take active bets. So right now, our active bets are plus 2% above benchmark and about minus 2% below benchmark. Those are our biggest active bets we take in this portfolio. You can see our biggest active bet is actually Canadian Pacific Railway, and it also has an A ranking. And we have Kirkland Lake, that's our gold exposure. And you can see down the other weights here that have active weights. On the negative side, our biggest negative weight is Enbridge. It's got a D ranking. So typically what you'll see is our biggest negative active weights have lower rankings, and our biggest positive active weights have higher rankings, obviously. So we're very systematic about that. We drive in those, we balance our portfolios each month using a risk model. Now looking at some of the names in CANGLOBE, generally, as I mentioned, our view we've become more defensive within our portfolios. Our CANGLOBE is focused on the benchmark, and you can see the names in here I would say, are more defensive. We have less technology in the portfolios right now. Within Canada, we have Rogers, basically infrastructure, cable media, Magna Auto Parts, one of the best in that space. Alimentation Couche-Tard, that's corner stores, and then exposure to gold. In the U.S., ConocoPhillips, our fossil-free wouldn't have that, of course. MetLife Insurance, and Exelis is a biotech firm. Intuit is TurboTax. So we don't have any exposure to FANG right now. Facebook, Apple, Netflix, and Google. We're naked in those stocks. And in EFA, we have more defensive names there as well. We're starting to keep a little exposure to materials. We think if we can get the US dollar weakening here, or at least slowing down, we can get more exposure. We can get some economic sensitive growth going forward. Yeah, these are just a sample of the stocks. The previous page was an example as well. We have between 60 and 70 names in the portfolio. But these are our feature names, and these are our top active names you can see here. We have a lot of those names in the previous page, and here's our stocks that were underweight. Now looking at the dividend strategy here has the same benchmark, but we're focusing on less beta or less market sensitivity. Our beta there is about 0.75, so we're more defensive. It's a low volatility, high yield strategy. We're shooting for a dividend yield of 4% with lower volatility. And we think that's a good place to park money right now. If we're in a trading sort of a range-bound market over the next year, market goes sideways, you can get your 4% yield with less volatility. And within the portfolio names we have, big names, infrastructure names in Canada, TELUS, Royal Bank, a REIT, which is really is Smart Centers REIT, and Fortis Utilities, gas utility, and within the U.S., ConocoPhillips, MetLife Insurance. IBM just reported last night. We've been suffering with this wait for some time. It's got a nice carry, 5% yield. They are up, I think, 6% this morning. Their cloud business is building out. They bought Red Hat, and that's starting to get some traction. So they're moving ahead some of their competitors like Oracle in that space, which is good for a stock that's languished for some time as we've been holding up because of the big yield. Entergy, electrical utility in the U.S., and then we have Roche, financials, DNB financials is in Nordic, and international materials in that space. So you can see the yields are very attractive. Overall, the portfolio is yielding 4% with lower volatility. I just want to mention our high impact strategy for our fossil-free clients here today. What do we mean? I guess number one, what is impact? People saying, what the heck is impact? Well, impact is, there's three ways you can look at stocks really in terms of from an ESG perspective. And the first is, is there value chain or process? Is it harming the environment or harming people or their customers? The second is their product harming the environment or harming the marketplace? And the third is their product actually doing something good for the economy, for the environment, for example? Tesla would be a case in point. And so companies that are seen to be doing good things are called impactful. They're doing something that's going to actually benefit the planet. And that's why they're typically called impact companies. And you can measure what we do is we measure the impact. We look at their total revenue and how much of that is actually having an impact on the environment or society. And companies like Tesla for example, would have 100% of their revenue being impactful, doing good things. So the reason we call the impact fund high impact is because 50% of the revenues of this portfolio are having an impact in terms of making the planet a better place. And the marketplace, the average impact of the overall benchmark is between 4 and 5%. So it shows you it's leaning hard into these impact areas. Some of the companies we have there, just quickly, Vestas Wind System, biggest turbo manufacturer in the world. Berkeley, they have green homes, energy efficient homes they build. Eli Lilly's into diabetes and disease, and they're also focusing on emerging markets. Also, we've got cloud companies like VMware, which have virtual PCs and Citrix, which are big into, working at home, VPN type things. So it just gives you a lot of exposure. In this portfolio there tend to be more impact companies in Europe versus the US. That's changed somewhat over the past couple of years with more technology companies getting into the space because they're actually really having an impact on efficiency and travel and everything else. So that's a bit about our impact fund. And in terms of summary, looking at the footprints of our dividend strategy and our CANGLOBE versus the benchmark, number of stocks in Genus dividend strategy 53, CANGLOBE 66. Dividend yield is advertised 4% versus 2.3 for our CANGLOBE. So the CANGLOBE is more benchmark driven. This is more focusing on yield and safety. And so if you look at the enterprise value, EV stands for enterprise value to EBITDA. It's a value metric. Lower the better. Lower means better value. You can see that the benchmark is 13.9. Our CANGLOBE is 9.2. We have less technology, less of the high flyers that have high valuations. And our dividend strategy is definitely more value than this. Typically, this is a bit higher, but given our current cautious state, this is a bit lower than normal. 5-year earnings growth, you expect less growers in the dividend strategy, 7.4, and we're 10.5 versus the benchmark of 11.0. As I mentioned, we have less of the high flyers in the space in our portfolio right now. Debt to equity, lower, 1.1 versus 1.3 here. Typically, defensive stocks, utility stocks have more capital in the nature of their business. They tend to have more debt to equity. And if you look at the return on equity from both strategies, definitely higher than the benchmark, 18% and 16.6. So this is all just a manifestation of our models. They're driving in value. They're driving in quality of the portfolio. And then this here is the portfolio construction process. Beta 0.75 as advertised, and a CANGLOBE beta of 0.96, a bit below the market at this point in time. So that's our equity strategy. Any questions at this point in time? Yes. Oh, we hold around 30 companies. And if you look at those companies, some of them are 100% impactful, like Tesla, for example. But some of them, only some of the revenues are maybe 50% impactful. So when you add those up in an aggregate sense, we only get 50%, which is very hard to do, and very, very, very high impact, actually. No, we don't. And I think the thing here, we don't. Here's the thing. I really think the important thing when you're looking at impact investing, I just don't think you just dive in and buy everything impactful, because some of these, there's a lot of, you have to look at their business models. And I think there's been a problem with Tesla's business model in terms of getting it off the ground. I think they can work this out longer term. It's a great company, great leader, everything else. But they had a problem with their production process, and they came like 6 months from going belly up. So it's important to actually look at performance and companies. We're trying to find companies that are sustainable. If they're not sustainable financially, they're not sustainable. So the fundamentals do matter in that space. And if you can get a company with good impact and good fundamentals, it becomes, I think it's going to be really awesome if Tesla can get this turned around and become, we'll probably go and buy it then. But those are the kind of companies you want to buy, I would say. They're really impactful, and they have a good business model as well. Yeah. Sure. Just before, at 6 o'clock.
Can you come work at Genus?
Yeah. And one of the things we want to put up too, we showed you a footprint here of the fundamentals of each of these portfolios. We also have a ESG or fossil-free footprint as well for our impact fund. For example, our impact fund is 100% fossil-free. It's got no fossil fuel exposure versus the benchmark. It's also got 70% less carbon emission than the benchmark. And its ESG score is probably 20% higher than the benchmark. So it has all those good things that clients that are interested in the space want. And it's got decent fundamentals as well.
But yes, next year we're going to do that, Jack.
Sure. Yeah, that's Alberta's really hurting right now. I was actually scheduled to go to speak at a conference there in March, and I was canceled. And I was going to talk about our macro strategy, and they said, no, don't want to hear your macro strategy. We want to talk about survival. So they're really hurting and feeling the pain. Global prices have obviously impacted them, but the fact they can't get the oil out of Canada is also a problem. We have a lot of exposure. We manage, about a third of our assets we manage are in the fossil-free space. So we actually manage money for environmentalists and all the people in that space. So we learn, I'm a financial engineer, but I've learned a thing or two about the whole environmental space. And the fact is the environmentalists don't want the oil to leave. They want to keep it underground effectively, and they want to keep the dirty oil underground. And if you look at divestment movements, I've studied more the history of divestment movements. Typically in a divestment movement, when they're divesting from a space, a certain area gets stigmatized. Well, coal's been stigmatized. It's been stranded effectively. And the other space that's being stigmatized is the oil sands. And you've seen all the international players divest from the oil sands. They've sold them to local players. All the big majors have got out. They want to clean up their brands because they're concerned about their image. So that's impacting as well. So, the question is, what happens longer term? I just think it's my view is that we're probably we're going to need oil for a while yet. We're going to need oil for a while, but technology is going to probably bend the demand curve for oil in terms of what's happening with Tesla and electricity and everything else. So who's going to pump the last bit of oil in the world? It's probably going to be the Saudis. They have the cheapest oil. And what's going to probably be the next area to get stranded? Probably the more cost-expensive areas, and most likely the oil sands. I hate to say that because I have family and friends that live there, and I can feel their pain on Facebook. But it doesn't bode well, I think, for Alberta longer term and Canada. And I was actually, when I was first hired in this business, I was hired to manage part of the Heritage Trust Fund back in 1980, believe it or not. And then the Heritage Trust Fund was $18 billion, and it was going to be used to diversify the economy. Well, here we are, 40 years later, and the Heritage Trust Fund is $18 billion, and they haven't diversified their economy, and kind of doubled down on it over the years. So it's a concern to me, and I think from an industrial policy, I'm saying, where is Canada? Why aren't we having a conversation about what do we do after oil, given the impact on Western Canada? And in Canada, in Ontario, you've got Toronto's 5 big banks and all our suppliers and some insurance companies, and out west you got oil. So where do we go from here? And I think we should be pushing more technology, doing something there's a lot of resources, a lot of talent in Alberta. Where does that get redeployed longer term? And moving maybe towards renewables? I don't know what, but there should be more discussion about that in Canada, and I don't see it happening. Anyway, that's probably that's just my thoughts on that space, but I'm concerned about it.
Thank you, Wayne, very much. So it's my opportunity to wrap this up and talk about what's gone on last year. We've obviously used the models that Wayne's talked about to do some changes in the portfolio. I'm going to focus on our balanced fund. Our balanced fund is not everybody's portfolio, but it does reflect the same moves that happen in that fund happen in everybody's portfolio, unless you have some crazy goals that some people do have. But this would represent about 65% of our clients. And we always try to say, well, where were we a year ago and where are we now? So this is the asset mix of our balanced fund a couple days ago compared to December 2017 a year ago. So what have we done in this past year, and is it consistent with our models? So what we've done over the course of the year, and your quarterly reports are very transparent. You can see this pie chart for each of you every quarter, so you can see these changes happening. What we've done is we've sold CANGLOBE, that portfolio that is more of a growth portfolio, from March, really. We didn't actually start selling till the spring, but from March till September, we sold you can see the equity weight went from 67 to 59%, so 8% was sold, and some of that went into cash, and some of it went into the defensive portfolio, the dividend portfolio. So it stayed in stocks, but had a more defensive posture. And then recently, you can see that the fixed income's gone up. So some of that cash very recently, not at the beginning of the quarter, not in September, unfortunately, but closer to December, has gone into bonds and global bonds, and sorry, government bonds. So that's the changes that have happened. These federal bonds and provincial bonds totaling 9%. We haven't owned government bonds really since '07. We had that emergency client meeting at the Four Seasons, which I'll never forget, December of 2008. And I remember Wayne saying, the government's sick, the consumer is sick, but the corporations are healthy. So we're going to focus on dividends and corporate bonds. And we're not going to own government bonds. And we haven't owned government bonds for basically a decade. So we've really moved into them. Now we can get a return from them now, finally, and we don't feel that interest rates are going up there. So we're finally feeling comfortable owning government bonds. This is a picture of our balanced fund portfolio before fee, but after all expenses, from June 1989, when we started with 13 brave clients, and up to today. I always think it's fascinating. There's fascinating stories in here. The world stock market is this line. You can see it peaked in tech bubble burst in 2000. Took 13 years to get to higher ground. I'm just taking this all the way across to here. Took 13 years for it to recover. The Canadian stock market is the red line. This is like the 25% move down when the the Thai baht collapsed. If you remember that currency problem. You can see how volatile Canada is because we're so undiversified. And then you can see the move from '02 to '07 when the price of oil peaked at 140, Canadian dollar peaked at 110. So really extreme. The red line where we live is very, very volatile. The green line is the bond market, and for the first 22 years of our existence, it was as good as any stock market, which every textbook would tell you doesn't happen over the long term. So finally, the green line, the bond market, is not the place to be. And the textbook would tell you that you get more return from stocks, so it's happening. The blue line is us. We want this line to be as straight as possible. We're not trying to be the highest returner. As you all know, we're very conservative working with your plans, but we do want that line to be straight, and that means less volatile. So let's look at the last 5 years rather than the last 30 years. So the bond market has been stable over the last 5 years, but really not very rewarding. The stock market in Canada is 4%, but a bit bumpy. The world stock market has been up 11% in Canadian dollar terms, annualized over the last 5 years. So that is the train we talked about at the beginning. That's the US, that's the Federal Reserve flooding the system with cash and liquidity, and those stocks doing very well. And the balanced fund in Canada, 6% before fee, but we're very proud that it's above our domestic stock market, it's above our domestic bond market for 5 years. That's really, we're very happy about that. And of course, the line is we went down in the fourth quarter, but nowhere near as much as the stock market. So that's the performance. We're going to end with how our business model really changed in 2008. We realized we needed to do more for our clients. We can't just pick stocks for you and manage your portfolios. We've got to make sure you have the right plan. So we call it retirement planning there, but it's really cash flow planning. Many of you have sat through with your portfolio manager where we see what is driving your whole picture. Are you exposed properly, and so on. And it's really, really important that you work with your portfolio manager because the markets will be volatile, and when they are, we need you to say to yourself, this is part of the plan. This is acceptable. And we also, of course, manage money, and we're getting more and more involved in putting on seminars with tax advisors, estate advisors, and just try to help you. We had a seminar this fall from Koopman, the health people in private health. We really want to make sure we understand you really well so we have your proper risk profile. So that's it for today. Thank you very, very much. I don't want to cut off if there's any questions. Before I let you go, I just want to thank Justin very much. Justin is our in-house economist in the very back. Thank you very much, Justin. He's been behind all these slides, so really appreciate it. Thank you, everybody, for your attendance, and have a great day.